Hey guys, so in this video I want to talk about the price to book ratio, which is a continuation of the stock price valuation series that I've been doing. So there should already be a couple of videos in this series. If you haven't already watched those yet, I recommend watching them first. But in this video we're going to talk about price to book value of stocks. So what is the price to book ratio of a stock? It's essentially where you take the stock price and divide it by the book value of the company. So the book value of a company is essentially the shareholder equity of the company. So you can think of it like the net assets of a company, in the sense that, as I've spoken about in a previous video, when a company forms, it issues shares or stocks or equities, and people inject their capital into that company, and they take that capital and buy assets with that capital. So they might take that equity and go buy plant machinery and equipment, or build a factory, or buy some farmland, or invest in something, and then hopefully with that investment into those assets, they produce a return for shareholders over time. So when you're looking at the price to book ratio of a company, what you're looking at is, okay, how much assets does this company have, and how much does it cost me to buy a share of those assets? Because when you buy a stock, you're essentially buying part of those assets and the future income and revenue of those assets. So when using the price to book ratio, essentially what you're trying to do is you're trying to find companies that have assets that are worth more than $1 with a share price that's worth less than $1. Using this sort of stock valuation method is particularly good with companies that have a lot of tangible assets, like a lot of things that you could take and sell off into the market as an individual piece of equipment or asset or something. A lot of companies that have a lot of intellectual property, like maybe a biotech company, or more service orientated companies where it's more about having good employees, like maybe a consulting company, whether that's a mining engineering company or an accounting firm, or a legal firm, that they're tangible assets in terms of physical goods, of sort of physical products and equipment, and and infrastructure may not be substantial, but there's a lot of intellectual property and systems in place that don't necessarily show up well on a balance sheet, especially, or they often get put down as an intangible asset on the balance sheet, or as goodwill. And and in many book value calculations, people do it subtly differently, that some people might include the intangible assets in a book value calculation, and some people only consider the tangible assets of a company as part of a book value. It doesn't tend to be a good ratio to use for companies that have a lot of intangible value, in the sense that Google or Apple or Coca-Cola might have a lot of brand recognition, and as a result that brand is worth a lot, but it doesn't necessarily have any fixed tangible thing that can be sold. So as a result, their book values are often traded significantly higher than the shareholder equity in the companies, because they've been able to increase their revenues and their profitability without necessarily buying a lot more physical assets or injecting a lot more capital into that company. So in addition to that, a lot of investors or potential new entrants into a market might look at existing companies in that market and what their book values are trading at, in the sense that if you're a canning factory, and your business is canning food, and it might have cost you $100 million to set up that factory, and the stock price is currently trading for $70 million, and they have no debt, so they can sit there and go, oh wow, so if I want to a competitor might be like, oh, if I want to set up a new company in competition, it's going to cost me $100 million to build that new factory, but I might be better off just trying to buy out this company that's already a canning factory and already has all the infrastructure for $70 million, which is less than its existing book value, which is, might have originally been $100 million. So essentially, it doesn't make sense for new entrants to come into the market when book value of existing companies are really low, they would be probably more inclined to look for takeovers and acquisitions and mergers at that point. On the flip side of that, often a low price to book ratio can be the market's way of indicating that it thinks the assets that the company currently owns are potentially overvalued on the balance sheet of that company, in the sense that if you were an analog camera manufacturer, just as digital cameras were coming into existence, you might think to yourself, oh wow, this factory produces outdated cameras now, so as a result, the returns of those assets over time are going to be significantly lower than what market expectations might be, or they may not even be able to be sold at anywhere near what they currently put on that company's balance sheet for. So in that sense, there may be investors that are expecting the management of that company to, at some point, write down the value of those assets and basically tell shareholders, hey, look, this used to be worth X, but now it's only worth Y. On the other hand, when the price to book ratio is above 1, that's the market's way of saying that the assets of this company are worth more than what this company paid to produce them or acquire them, and we're expecting a larger return on equity than what would have been expected by the broader market, so thus a higher price to book ratio. So when a company has a price to book ratio above 1, if those superior returns on equity aren't achieved, there's more downside potential for that company, in the sense as the market will need to correct the value of those assets back to maybe a more normal level, or even below normal level. So in that sense, you can look at book value as like the strip value or the liquidation value of a company, and when you have a low price to book value ratio, there's almost like an incentive there for a company to try and sell off its assets if its assets are truly valued at the correct price. So one of the drawbacks of using the price to book value ratio is that the book value is really only looking at the balance sheet of the company. It's not really reflecting on the operations or the cash flow of the company, and it's not looking at the future returns on equity of those assets. It's really just putting a value on what the company currently owns. So because most shareholders only own a minority stake in a public company, and they don't control the management and don't control the operations of the company, if a company is trading significantly below book value, it may make rational sense to try and liquidate the assets of that company and then just distribute those proceeds back to shareholders. But because management controls the company, they may want to keep operating the company for whatever reason, because they believe there's better prospects in the future, even if cash flows are currently negative and they're currently destroying capital of the company by running losses. So the price to book value ratio doesn't necessarily give you a holistic view of that company, because a company can't run losses forever. It eventually will destroy all its equity. So you want to look for companies with a low price to book value ratio or a decent price to book value ratio, but hopefully also with good cash flow prospects or free cash flow prospects in the future. So I hope that's given you a bit of an idea about what the price to book value ratio is and how you can use it and what you might look for. If you've enjoyed this video, be sure to like and subscribe, and I'll see you in the next video.